Hi, I'm Eric Weisbrod at the University of Kansas, and I'd like to welcome you to this lecture about the difference between operating and financial activities in the context of equity valuation. If this is the first video you've seen in this lecture series, I'd like to point out that this is actually the fourth video in a series of videos on equity valuation. If you haven't caught the others, you might want to look in the notes below the video to find links to the prior lectures and start there. If you have been following along, you might be wondering if you're in the right place since I'm a different Eric than was leading the prior lectures. We have a new Eric today. So the prior videos were by Eric Johannesson at SUNY Brook in New York. As I mentioned, I'm Eric Weisbrod. Have no fear, you're still in safe hands. First of all, I have experience with these topics in a variety of settings. I taught financial statement analysis to master's students at the University of Miami for a number of years before coming to KU. I currently teach advanced financial accounting to our master's students here at KU, as well as financial accounting research to our PhD students here. Before going back to grad school, I worked in consulting, doing valuation in the context of complex securities class action lawsuits, estimating damages, things like that. I also spent a year in the office of the chief accountant at the Securities and Exchange Commission, learning some of the real world concerns of companies that are trying to report their operations. Now, you're also in safe hands in that this continues to be joint work with my longtime mentor, James Ohlson. So I first learned a lot of the concepts that we'll discuss today when I was a student in Ohlson's class when I was getting my PhD several years ago. And since then, I've continued to reinforce these through teaching my own classes and working with Jim. And so as we go through the material today, you'll find his thoughts combined with some of the things I've layered on during my years of teaching. So to hop into the material, the topic today follows from the prior lecture. The prior lecture introduced the concept of dividend policy irrelevance and the notion that a company might create value in one period and then distribute it later on in another, and that shouldn't affect our valuation. Following forward from that, the primary way that a company creates value for its shareholders is through its operating activities. And so today we're going to discuss the distinction between how a firm conducts its operations and generates operations versus how it finances those operations. And so that can either involve raising money to finance the operations or distributing the cash we generate from the operations back to our shareholders and debt holders. Another thing that we'll talk a lot about today is free cash flows. As I'll show you, free cash flows really conceptually are the bridge between the firm's operating activities and its financial activities. Understanding that concept is going to help you apply the concept of valuation using free cash flows, as well as help you understand what we can and cannot measure by looking at free cash flows. And then lastly, operating income can be decomposed into two components, free cash flows and accruals. In order to do that decomposition, we're going to have to be able to classify all of the income and balance sheet items into operating versus financial activities, and then understand the implications of both free cash flows and accruals. As I talk today, I'm mainly going to be focused again on this conceptual framework in discussing these concepts. You'll also find a lot of the language that I'm talking about today discussed in your common financial statement analysis textbooks. The key difference between what you might get from me and what you might get in the textbook is, again, I'm going to talk big picture, whereas the textbook might get more detailed and try to go into a giant spreadsheet model for a particular company. As I talk today, I'll try to give you some advice on where to focus your time versus perhaps not waste your time on some of the more detailed textbook concepts. Okay, so the basic definition of operating and financing activities for me is easiest described in simple examples. So let's say Starbucks. Their operating activity is making and selling coffee. So all the things that relate to their coffee business, such as paying the baristas, buying the beans, the cups, all the equipment they need to roast the coffee, all that stuff is part of the operations. Whereas raising money to open new stores or paying out dividends, those are things we think of as financial activities. And another important one is if they have extra cash that perhaps they invest in other companies or buy bonds in the market. Those are other types of financial activities. A key thing to point out is that if you've taken an accounting class and you learned about the statement of cash flows, you might be thinking of the categories on the statement of cash flows, which are operating, investing, and financial activities. That's not the framework that I'm teaching today. Today, this framework is specifically from an FSA or valuation standpoint. And in this framework, we only have two categories, operating and financial. And everything is going to touch one or the other of these two categories. Some transactions involve both. So as I mentioned, free cash flows involve transfers from operating activities to financial activities. But I just wanted to point out that the two categories are comprehensive. There's no third category. And then finally, as we go through, we're going to be classifying every item we see in a company's financial statements as operating or financial. As we do this, the most practical way to approach it is to look for the financial items first. They're usually fewer in number and easier to identify. And a key rule that I'll repeat over and over is when in doubt, just leave it in operating. So we're going to go through as part of our exercise today and identify specific financial items, and then everything else will be classified as operating. In order to facilitate this, I'm going to go over some vocabulary with you. This is some specific vocabulary and notation that I'm going to use as I'm talking. But more generally, I think a lot of this lecture and a lot of what I tell my students in general is accounting is the language of business. And so part of my goal today is to give you the vocabulary to have a conversation about valuation or understand when an analyst is speaking. And so a lot of times these terms get muddled together in the real world. So I'm introducing this notation for clarity, and I'll try to point out along the way where something that I might refer to using one term, you might also see referred to in alternate terms when you go out into the workplace. So some of the letters I'll use, as you can see straight above me, T stands for total, N stands for net. I'll let you read through these. And then really I'm just giving you these basic building blocks. Hopefully this is review for a lot of you, but just to do the brief decomposition. The traditional balance sheet, we have total assets and total liabilities. What I'm going to be teaching you today is to decompose total assets into financial and operating assets, and total liabilities into financial and operating liabilities. So as I said before, there's just two categories, operating and financial, and everything is one or the other. Once we classify them, then we'll do what we call reformulating the balance sheet to separate the operating side of the balance sheet from the financial side. So on the operating side, we're going to take our operating assets less our operating liabilities, and we'll refer to that as net operating assets. On the other side, I'm actually going to flip the order and do financial liabilities less financial assets for net financial liabilities. Now, a lot of businesses are leveraged in that they take on debt, and so oftentimes financial liabilities will outweigh financial assets. So that will be my default terminology, but a firm could just as easily be in a net financial asset position, and I'll show you an example of that later today. So just depending on which of these two is larger, it could be either net financial liabilities or assets. Now, moving forward with this net financial liability vocabulary, at the end of the day, we have our traditional balance sheet equation which was total assets minus total liabilities equals common shareholders' equity. In our reformulated balance sheet, we'll take our net operating assets less our net financial liabilities also equals common shareholders' equity. So all we're doing is rearranging things so that now both of these are on a net basis, but we're saying the equity holders also get the difference between the operating assets and the financial liabilities. We can do the same thing with the income statement. On the income statement, instead of just looking at total revenues less total expenses gives us net income, we're going to break this also into operating income and net financial expense. So operating income is our operating revenues less our operating expenses, whereas net financial expense, the same way that a lot of companies have more financial liabilities than financial assets, a lot of companies have more financial expenses than revenue. So my default terminology will be net financial expense. Of course, you could be in the opposite position and have net financial income. Regardless of which way this turns out, your operating income less your net financial expense will also get you to net income. One other thing I'll reiterate as I go along, but in the traditional income statement, we have one line for revenues, then several expenses underneath that, and then towards the bottom of the income statement, we have one line for tax expense before we get to net income. Now, since we're splitting our revenues and expenses between operating and financial, in the reformulated income statement, both of these amounts should be after tax. So you'll have some tax that relates to your operating activities and some tax that relates to your financial activities. So both of these on an after-tax basis will get you to net income, which is also on an after-tax basis. Okay, now that I've covered the basic terminology, I'd like to give you a big picture overview of the concepts that we're discussing. The picture that I have for you is a picture of the firm over a fiscal period. And if you look at the box here, this represents the firm, and inside we have the reformulated balance sheet with net operating assets on one side, net financial liabilities, and common shareholders' equity over another. Now, during the period, which covers the time between one balance sheet date and the next balance sheet date, the firm engages in transactions with the world, and those lead to changes in the different sides of the balance sheet. One way in which the firm can transact with the world is by engaging with product and input markets, usually for operating activities. So examples would include selling merchandise to customers or buying supplies, raw materials from suppliers, paying our employees. Those are examples of operating revenues and expenses. Now, even though they're on this side of the picture, it's important to note that these transactions can touch either one or both sides of the reformulated balance sheet. So the key important thing to remember is cash is a financial asset. So it's over here on this side of the balance sheet. I'm going to beat that into you today and cover it time and time again. Think about a basic example where we sell merchandise to customers for cash. That's going to affect both sides of the balance sheet because we're going to be giving up inventory, which is an operating asset, and collecting cash, which is a financial asset. That leads to another important part of the picture, which is where we have free cash flows in the middle here. Now, the conceptual definition that I want to give you for free cash flows is a transfer between operating and financial activities. And this transfer can go both ways if you see the arrow points both directions. So when we generate cash from our operations, for example, by selling merchandise to customers, that is a positive free cash flow. Our operations have generated cash, and now that cash is sitting there available to be distributed. It's free for distribution. It doesn't matter whether we actually mail a dividend check to our shareholders today or leave that cash in our bank account and then eventually use it to pay off a loan. Either way, that's a free cash flow generated by our operations. On the other hand, let's go ahead and flip over to this side of the picture today, right now, and talk through it. On this side of the picture, we have transactions where we engage with our creditors and shareholders. And those transactions could either distribute or generate cash for the firm. So we could distribute cash to our creditors and shareholders, whether it's in terms of interest payments or paying off the principal on a loan, or we could send dividends out to our shareholders or do a stock repurchase. Oftentimes in the lecture, I'm going to use the term net dividends to refer to any type of payout to our shareholders. It doesn't matter whether it's in the form of a dividend or a stock repurchase. We can also take money in from our creditors and shareholders by either issuing debt or issuing stock. And so then going back to the concept of free cash flows, if we take money in, let's say we take out a loan, if that money stays in cash, then it stayed here on the financial side of the balance sheet. However, if we issue debt and then use it to buy a factory or invest in our operations in any way, that is going to generate what we call negative free cash flows. So when I buy an operating asset like a factory and the money came from my creditors or shareholders, that leads to negative free cash flows. And so that's not necessarily a good or bad thing in terms of value creation. Free cash flows are simply the way we account for transactions that involve moving money from the operating to the financial side of the balance sheet or vice versa. As we go along, I'm going to keep talking through this concept of free cash flows linking operating and financial activities. But before we get back to that, let's go over the basics of how you classify items as either operating or financial so that we can then continue talking through the different concepts and transactions. Starting with the balance sheet, as I mentioned before, we can first identify the financial assets and liabilities, and everything else we'll just classify as operating. The rule is, when in doubt, treat it as operating. So the clear financial assets are things like cash and marketable securities. Notice it doesn't matter for the marketable securities whether this is a short-term investment like a 3-month certificate deposit or a long-term investment like we're going to buy some bonds of another company and hold them to maturity. The timing doesn't matter. There's no current and non-current here. It's just the purpose of this is a financial asset, so we're going to classify it as a financial asset. Financial liabilities are any type of bank debt, commercial paper, bonds payable. Maybe one to focus on preferred stock, even though on the balance sheet we often see it in the equity section. For financial statement analysis, we're going to treat this as a liability to our common shareholders in that they have to pay fixed sums to the preferred shareholders. These are really the basics that I want to focus on, but I'll briefly mention that there can be several judgmental issues that you'll find dealt with in textbooks and that analysts often think through on a case-by-case basis. I'm not going to spend time going over every single one of these, but briefly, the first one, I've talked a lot about cash today. I'm going to just always treat cash as a financial asset, but some textbooks or financial analysts will argue that a small portion of cash is needed to finance your day-to-day operations, petty cash, things like that. And so some analysts will break cash into, say, 10% that's required for operations and everything else is an excess financial asset. Another one to spend a minute talking about is on the GAAP balance sheet, non-controlling, or sometimes we call this minority interest, appears in the equity section of the balance sheet, but textbooks will generally treat this as, again, a liability, sort of like preferred stock. So the common shareholders, this is value that is not going to accrue to them. It's instead going to accrue to this non-controlling interest. I generally think it still is related to the operations, but textbooks will treat it as some type of either financial or operating liability, not an equity. On the income statement, again, we're going to first identify the financial items and then leave everything else as operating. But the way this plays out on the income statement, it comes off as a bottom-up approach where, well, if we start with net income and then just add back the net financial expense, that will just leave us with operating income. So we can identify the different financial items. So on the income statement, this is usually things like interest expense, interest revenue, gains and losses on marketable securities. These are the financial income or expense items. And then, as I mentioned, we add those back to comprehensive net income to get us back to operating income. And then a key thing to remember once again is that these amounts all have to be after tax. So when it comes to the judgmental issues, a big one is always that single line of tax expense that we see on the income statement. How are we going to split that between operating and financial activities? Usually what we'll do is just use like the maximum statutory tax rate, say it's 35%, and then just tax effect both of these items. Say if my pre-tax financial expense was 100, I would do 1 minus the tax rate. So say 65 is my after-tax financial expense, and so on. Other comprehensive income, things like unrealized gains and losses on security, those can also lead to judgmental issues in terms of where to allocate them. And again, non-controlling interest is something that we might have to deal with. So I'll defer you to the textbook if you really want to get line by line into these things. What I'm going to talk about today is really just the basic approach to reformulation. So sticking with the basic approach, let's just do a very basic example using a real-world balance sheet. So this is the actual balance sheet for Apple for 2022. Notice I've just shortened a few things. So the equity section on Apple's real balance sheet, it has more lines, but I'll give you a hint. Everything in Apple's equity section was operating, so I've just left the total here and you can classify it all as operating. For the other items, why don't you pause and take a minute and see if you can identify the financial items on Apple's balance sheet. So hopefully you gave this a shot. These are the ones that I'm going to highlight in green. So again, cash is always a financial asset. Marketable securities, it doesn't matter if they're current or non-current, they should be classified as financial. And then on our liabilities section, the commercial paper and then any type of, again, like bank debt or bonds would be financial. And notice the things that I wasn't sure about, so other, instead of digging into the details of each one of these other assets, I'm going to go with the basic rule, when in doubt, just treat it as operating. Same thing for the liabilities. Okay, the last thing I'll cover in this simple example is what we do once we've identified the financial items. So all the items that we coded as financial, I'm going to put here on the right side of the balance sheet. And everything that's operating, I'll keep on the left. And so these ones in red, I've moved. So I've moved the operating liabilities over to this left side of the balance sheet, and they become negative numbers so that we have our operating assets less our operating liabilities gives us 1.6 billion in net operating assets. Now on this side of the balance sheet, since I'm using the terminology of net financial liabilities, these things that I've classified as financial assets, I'm going to list as negative numbers, and my financial liabilities are positive numbers, but Apple has more financial assets than liabilities, so they're in a net financial asset position, which I've denoted with a negative number here. If we net those financial assets against Apple's common shareholder equity, we see that our net operating assets equals the sum of our net financial liabilities and common shareholders equity for also 1.6 billion. So one thing we learned from this very simple example is that since Apple has so many financial assets, this $50 billion of shareholders equity on the balance sheet is really split between the shareholders' interest in the net operating assets and a big investment fund that Apple is running on behalf of its shareholders. So a big chunk of what we see in shareholders' equity actually relates to their interest in all of these marketable securities. And so when you're valuing Apple, you need to value both its operations and what you think you have a right to as a shareholder in terms of all the things that Apple's invested in terms of marketable securities. Okay, now that we have our reformulated balance sheet and income statement, we can use them to decompose operating income into free cash flows and accruals. Let's start with free cash flows, and I'll talk you through the operating and financial perspective for understanding free cash flows. Let's actually start with these notes up here on the right-hand side. If you look where it says intuition, the key intuition is that the operating activities are the driver of the free cash flows. So hopefully our operating activities are going to generate free cash flows that we then dispose of using our financial activities. However, it could also be the case that we need to invest in our operations, but we haven't generated any income, so then we're going to have to raise the deficit using our financial activities. Let's look at this in terms of the equations that give us the definitions. So this first equation defines free cash flows as our operating income less any increase in net operating assets. And note that the change in net operating assets is the net accrual, or in other words, any increase in operating assets less any increase in operating liabilities. Going back to the overall definition, think about the case where we generate income from our operations by, say, selling merchandise. If we fully reinvest that income back into our net operating assets, we will not have generated any free cash flows during the period. On the other hand, if we generate operating income and don't reinvest it in our net operating assets, it has to go somewhere. And the financial perspective will help us think about the other side of this number. So this is just bookkeeping. These two definitions are equivalent, but if we break down that same number in terms of its financial components, that money that we generate from our operations, it has to go somewhere. So it can either be paid out as a net dividend to our shareholders. Again, a net dividend could either be a dividend check or a stock repurchase. It could be paid out as interest expense to our creditors, or we could use it to decrease our financial liabilities. And there we have to remember that cash is a financial asset. So if we stockpile our cash, that also reduces our financial liabilities. Same with marketable securities, decrease our financial liabilities, or we could use it to, say, pay off a bank loan. Finally, let's say we need to invest in our net operating activities, but we don't have any operating income. The financial perspective will tell us that now instead we either need a negative dividend, so that would be like a stock issuance, or we need to generate financial income or increase our financial liabilities. A few things also to note on the right-hand side here is a lot of times when people talk about earnings, sometimes they mean operating earnings, or sometimes they just use these terms interchangeably, especially if a lot of companies only have immaterial amounts of net financial expense. Another thing to point out is I'm talking about free cash flows here, but sometimes when people talk about cash flows or cash earnings, sometimes they're talking about cash from operations on the GAAP statement of cash flows. That is not what I'm talking about here. I'm talking about these definitions of free cash flows that flow from our reformulated financial statements. Since understanding the role of free cash flows is central in valuation, I'm going to go ahead and give you a little quiz to make sure you understand the different examples I talked through on the last slide. So why don't you pause the video for a second and see for each of these, does it generate positive free cash flows, negative free cash flows, or no free cash flows? Stop and try these yourself, and then we can talk through them together. So this first one I mentioned a number of times. Let's say we generate cash from our operations, and we could either keep it in the firm's checking account, or let's say we reinvest it back into operations. So the first one, if we keep it in the checking account, is at positive, negative, or no free cash flows. That's positive free cash flows because we have an increase in operating income. And then on the other side, from our financial perspective, we're using that to decrease our financial liabilities because cash is a financial asset. On the other hand, if we reinvest the cash back into our operations, we have no free cash flows because if you remember our operating income minus change in NOA, those two are going to cancel each other out and we're at zero free cash flows. If we get cash from a debt issuance and still keep it in the firm's checking account, has there been any transfer between financial and operating activities? No. This is all on the financial side, so the debt issuance is going to increase our financial liabilities, but the increase in cash will decrease by financial liabilities by an exactly equal amount. Now, the equity issuance, if we invest that into our operations, that will lead to negative free cash flows. So an equity issuance increases common shareholders' equity. Or in terms of our equations from the last slide, you could think of this as a negative dividend. And on the other side, in the operating perspective, this is increasing our NOA, but it wasn't done through income, so this is what we call negative free cash flows. Notice that it's not a bad thing for the firm, it's really just bookkeeping to say that this investment from our operations, it came from outside funding. It wasn't funded by the operations themselves. And then finally, one that we see a lot in the real world these days is, like a debt equity swap where we issue debt and then use it to repurchase stock. So Issuing the debt is going to increase our financial liabilities, but then if we pay that back out as a net dividend, then the financial side of the balance sheet is going up and down by an equal amount. This doesn't touch our operations in any way, so there are no free cash flows, positive or negative. So the key points that I want you guys to remember about free cash flows is first that free cash flows only capture flows that move between operating and financing activities. That last example I just told you, if you raise debt to fund a dividend, that has no effect on free cash flows. And it doesn't generate any value from the company's operations. Another thing to keep in mind is that negative free cash flows happen when you invest outside money into your operations. It doesn't tell you if this is a good or bad investment. It's simply a bookkeeping device telling you that cash was raised in order to invest in your operations. Oftentimes, this could be a good investment. So oftentimes, growing firms that are going to increase their sales in the future have negative free cash flows in the current period. In fact, if you take the ratio of free cash flows to sales, it usually correlates negatively with sales growth. So companies that have large negative free cash flow investments use those to generate future growth in sales. On the other hand, companies that are generating lots of positive free cash flows are usually at the mature stage of their life cycle. They don't have investment opportunities for the future, and so those payouts are coming at the expense of declining future sales. Now, let's talk about the other part of operating income, which is accruals. So if we take our key operating definition of free cash flows and move operating income to the other side, we see that the same definition can be used to tell us that operating income is free cash flows plus the change in NOA. And we've talked about change in NOA as the net accrual. So some things that are different about the accrual component of operating income is that accruals depend on the accounting rules for GAAP. Think about changes in NOA. A big investment could be something like building a factory, buying a new operating asset. One thing that the accounting rules try to do is they try to match the benefit of that building with the expense in operating income, but it requires us to take some arbitrary rules. For example, straight line depreciation would say instead of expensing the cost of that building all at once in today's operating income, let's just split it evenly over the life of the building. But that requires us to estimate the life of the building, and it also could be subjective to say that the benefit of the building will be split equally over its entire useful life. Another thing to keep in mind when we're talking about accruals is that change in NOA is the net accrual, in that operating income increases with increases in operating assets and decreases with increases in operating liabilities. However, even though mechanically, bookkeeping wise, operating liabilities will reduce operating income in this period, they could actually be a good sign for future growth. So if we think of an operating liability like deferred revenue means we have an obligation to provide a product to our customers in the future. But on the other hand, it means we have a pre-order from our customer. It's probably going to lead to earnings in the future, right? We're not allowed to count that as a sale in the current period, but it's a very good sign that we're going to have additional sales in the next period. Or if we have accounts payable because we're increasing our inventory, we're usually doing that because we need to scale up our operations in order to generate sales in the future. So in the next lecture, we're going to get more into decomposing the net accrual into the asset and liability components, and then showing that these two components have different implications for future operating income. But for right now, I just want you to remember the basic fact that the net accrual is made up of both operating assets and operating liabilities, and that these can have different implications for future operating income. And then finally, I think that these operating accruals, despite the fact they're somewhat subjective, do provide us information about firm performance and help us with that timing problem of matching the benefit with the cost of these operating investments. However, the skeptic side or downside to including these accruals in income is that unlike cash is cash, the accruals are somewhat softer and based on estimates that can be exploited. So when people talk about earnings management or are skeptical of using accounting earnings as the value driver, it's because there is some concern that these accruals can be manipulated. And so that's something that you need to watch out for as an investor or analyst. Okay, I'm close to wrapping up this lecture, but I just want to take a few minutes to relate what I've been discussing today to the textbook FSA approach. Now, a common approach in textbooks is to decompose the valuation task of valuing common shareholders' equity between the value of the operations and the value of the financial activities. I completely agree with that approach and think it's great to keep in mind conceptually. The only thing that I would caution you against is the degree to which you can get a detailed spreadsheet that gives you the value of both of these things. So a lot of times the detailed spreadsheet approach would say, first value the financial assets, because the book values we get from the financial statements often approximate the fair values for the financial assets and liabilities. That's also totally fine. So we can simplify the valuation task by using the book values to approximate the value of the financial assets and liabilities and setting those aside to value the operations. It's actually useful to think of decomposing the task in that way because most of the value is generated by the operations, and that is where we want to spend time on the valuation task. The place where I would caution you is in terms of valuing the operating activities, the textbook approach would be to do a discounted cash flow approach where we forecast out all the expected cash flows into infinity and then discount them back to today's value at the weighted average cost of capital. Conceptually, that's fine, but putting that into practice can get quite difficult. So one key difficulty that you might face in terms of applying the textbook valuation model is this idea that you can discount free cash flows at some number that represents the risk of those cash flows, like the weighted average cost of capital. Trying to put a single number on the risk of operations is often a fool's errand, and I see a lot of times, even when you look at analyst valuation spreadsheets, sometimes they come up with whether they feel good or not about the stock, and then play with the weighted average cost of capital to justify whatever target price they would like to get for the stock. So conceptually, the idea that the weighted average cost of capital captures the risk of the firm's operations is fine, but the problem is that that risk is unobservable, and so instead people try to put a number on this using, say, the cost of equity or the cost of debt. And they do that using models like the capital asset pricing model, thinking that we can use return covariances and volatilities to put a number on this, is very artificial. So if you look at what real world value investors do, for example, Warren Buffett, he says, don't think about this in terms of weighted average cost of capital or the way it's taught at Wharton. For him, you really just need to understand what's driving the value of the operations and whether you're comfortable with the risk involved. And it's a no or no-go type of thing, not that this is a good investment at an 8% whack, but not a 10% whack. Another key thing to point out is that the notion that we can have a single discount rate is based on the notion of risk being in terms of volatility, that with some percentage this number might go up or down. But real world risk also relates to uncertainty, and it's not that we can just put a standard deviation on what will happen in our operations. There could be things that we've never thought of, and those are often the greatest risks, and they can't be captured in a simple number. Okay, so let's wrap it up and review the main takeaways from today's lecture. Going back to the beginning, we started with the idea of dividend policy irrelevance and the fact that value creation is distinct from how we distribute that value. Now that we have our focus on value creation, we can keep in mind that the key value driver when valuing equity is the value of operations. And by setting aside the financial assets and liabilities, it allows us to focus on operations, which are the key driver of equity value. Operating income, once we've focused on the income or value generated by our operations, consists of two components: free cash flows and accruals. But among these two components, free cash flows in some sense is more of a hard number in terms of its cash, and it doesn't depend on the rules for accounting for operating assets. It also helps us understand how we're distributing the income generated by our operations, in that if our operations do generate free cash flows, those are going to have to be distributed somewhere between the dividend, financial expense, or paying down a bank loan or stocking up on cash. The accruals capture the amount that we invest back into our operating activities. And next time we're going to go over the key point that the change in NOA is the net accrual, which is our operating assets less our operating liabilities. But those two different types of investment in our operations can have different implications for future operating income. And last but not least, the one takeaway I'd like you to most remember from today is that free cash flows don't capture value. They're not a performance measure. They capture transfers to and from operating and financial activities. Remember that negative free cash flows represent an investment in our operations, and negative free cash flows are often associated with growth in future sales. Look forward to seeing you next time when we continue talking about using the accruals and free cash flows to forecast future operating income.